Is it time to sell like Michael Burry might be suggesting? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that subscribe button. So let's understand what Michael Burry is saying, his thoughts on the market, concerns about the S&P 500 from here, where does the market potentially go, as well as some of the latest comments from Jerome Powell, Fed Chair, and what it can mean for the market. So let's understand what's going on. Well, this might come as a little bit of a surprise to you folks, because just a few weeks ago, I was calling out how Michael Burry had started to nibble for his investment portfolio. And if you watch the full video, I made it very clear, yes, he was buying, but he wasn't buying in size relative to where his portfolio was just a few quarters ago, over $1 billion. These were relatively small purchases. By no means was this a resounding endorsement that now was the time to buy. I think he was opportunistically buying at a few things that traded at low multiples to free cash flow during, I'd say, the lows in October. That's probably what was going on. And subsequently, you've seen some things rally a bit, but by no means was this sort of saying, hey, this is absolute bargain territory. He was nibbling on a few things, nowhere near full risk on exposure. Subsequently, you've seen from the October lows, you've seen a rally in the S&P 500, nearly 17% around that. And folks are wondering, hey, could this be the start of a new bull market? After all, you had Jerome Powell speak at the Brookings Institute, I believe earlier this week, causing like a 3% rally in the S&P 500 and various other, risk assets. Folks are saying, oh man, this is exciting. And what he was having to say is something very different than just a few weeks prior, where he was talking about, hey, I don't want to over tighten. I don't want to crush the economy. And that caused investors to say, this is a very different message than a few weeks ago. A few weeks ago, you were talking about, hey, you wanted to make sure you effectively killed inflation, and that you'd rather over tighten, because if inflation becomes ingrained in the economy, it gets harder to kill longer time, and the cost for society is even worse. And so this is a direct change in tone from literally not months, weeks ago. So folks might be wondering why. We'll talk about that in just a second. Could that mean, let's say, lower rate hikes? I think everyone's sort of on the same page. Maybe expect a 0.5% rate hike in December, maybe another 0.25% in January or February. So you're certainly, not ramping up, the rate hikes. They've done a lot of their 0.75% hikes. And so I think a lot of folks are saying, oh, okay, so now they're sort of going to wait and see. They've done a lot. They've raised rates from 0 to 4%, roughly. Going to be a little bit more after the upcoming rate hikes. And we'll see what happens from there. So it'll be between 4 and 5%. It's important to understand economic policy takes months, before it actually starts impacting the economy. You see it start impacting the most interest rate sensitive sectors first. And we'll talk about that in just a second. But before you start seeing it with the real economy, it takes some time. And so here it is. Michael Burry responded to this, seeing the rally, saying, look, 156 years ago, there was a market panic in England that led to the creation of the first modern style central bank, I believe Bank of England. He's talking about paving the way for the Fed and for our absolute dependence on every ducking word of its chairman. And it's always been about plunge protection. Clearly, I'm picking up frustration vibes from Michael Burry here, every ducking word. And what he's talking about is the panic of 1866, which arguably much worse than anything we're facing now, because in that period, over 80% of the joint stock banks that were formed in the previous few decades, got wiped out. And so this was a period where the Bank of England, I believe, stepped in, and that became the source of stability for the market that sort of turned things around. And so I think that's why he's calling out, like, hey, that is where we are today, where you have to rely, or investors are overly reliant on what did they say? What did the chairman say today? Just a few weeks ago, he would rather overtime. Today, he's saying he doesn't want to crush the economy, rah, rah. And he's saying, I think this is what he's getting at, is that we're overly focused on the individual words and not necessarily looking at the bigger picture. And so why would Jerome Powell potentially flip-flop? What does that bigger picture look like? Because clearly it's a 180 in terms of tone, from yes, I would rather crush inflation, to no, I don't want to crush the economy. He's still saying, yeah, I getting price stability is important, but why is his tone arguably flip-flopping? Well, I think the economic data has started to come in really bad, and that's probably giving him some jitters in some spots. I'm not saying it across the board, but in some spots. For example, pending home sales down nearly 40%. That's going to have a read through to all these companies that sell, one-off products that you use whenever you get into a new home, your sofas, your kitchen appliances, that type of decline, that 40% drop is going to lead to real problems for many companies. So if and this is why it's important for you to be aware of the type of companies you own. You want to own the type of things that have recurring revenue, because when you have a shock like this, which arguably mortgage rates going to 6-7% is a shock versus 3%, like a year ago. When you have a shock like that, that's going to cause a lot of these companies that sell these one-time goods to have problems, let's say scaling. And they might all of a sudden have it might be valued, you might say, oh, this trades at 10 times earnings or 15 times earnings. But the reality is, what happens if earnings fall by 50%? Or what happens if revenue falls by 30, 20% in response to, the declining pending home sales? And then your profitability gets absolutely wiped out, maybe your cash burn. And so that's a very important situation for you to think about for your own investment portfolio. Next up, you're looking at various different measures of economic activity, business barometers, saying, hey, this is registering with the COVID lows, with the great financial crisis lows, with the dot-com lows. I mean, this is with the recession in, the early 90s. This is clearly sending very strong recessionary signals right now. And this is not like just barely contracting. This is significantly contracting, and we're facing real trouble here. And you look at what the bond market is saying. Arguably, the bond market is more important than the stock market because it's multiples its size when you're talking about the bond market. And you look at the yield curve inversions, the percentage of yield curve inversions, something like 70% plus of the US yield curve is inverted. I've done a prior video on yield curve inversions, why it's important. So, it's important to effectively say that's when you have significant yield curve inversions, the super short summary is it's effectively the bond market saying, hey, the current interest rate environment is going to change dramatically because the Fed is going to be forced to cut rates in the future. And they're going to be forced to cut rates because economic conditions could get so bad. That's sort of the expectation. That's at least what the market's saying is like, hey, economic conditions are going to get a lot worse. And you see yield curve inversions typically happen around economic crises. So Michael Burry chimes in with his usual, happy-go-lucky self, saying, what strategy will pull us out of this real recession? What forces would pull us so? There are none. So we are really looking at an extended multi-year recession. Who is predicting this? There are none. This is a really interesting point because what he's effectively saying is if inflation remains elevated, see, this is a really toughy part that, investors haven't seen for many, many decades, is if you have, let's say, a shortage in labor and you have a supply-demand mismatch in another key sector like oil, those two key inputs can drive stickier inflation for longer. And then you factor in some geopolitical aspects, like, you're bringing production from China to onshore or near shore. Maybe you're bringing production to Mexico or India, but still expect the production cost to be much higher. So you have these inflationary forces like a super tight labor market, or you have, super tight oil market where oil supplies are declining. And you're saying, hey, that is structural inflation. No matter how much the Federal Reserve raises rates, no matter how much the Fed, tightens their balance sheet, that doesn't solve the supply problems that we're looking at here. What that might address is demand, and it really is like taking a hammer to demand. But what we're talking about and what's creating a real recession is the fact that the Federal Reserve is out of tools here, because they could lower rates, but that's still not going to solve the problem. And they really can't lower rates because if you still have elevated inflation, then they're saying, hey, our priority is price stability. So what happens to the market? This is the hypothetical I want you to be thinking about. What happens when you start seeing this really piss poor economic data, and the Federal Reserve says, hey, we're raising rates, or hey, we have to keep rates stable because inflation still isn't where we want it to be? What happens to the S&P 500 when they're like, oh man, we need the Fed to start easing up, but they're not doing so because they're saying, hey, we're going to keep at it to make sure we break inflation, which is arguably the mandate here. So sure, they might not tighten significantly from here, but they're not going to loosen as fast as the market is anticipating. And that's effectively what Michael Burry is saying. Hey, you're having real recessionary drivers here. The Federal Reserve isn't in a position to save us with, let's say, lowering rates. That's not even going to be an option unless inflation's lower. And by the way, there are some structural problems causing elevated and stickier inflation. Okay, so what happens from here? What happens to the S&P 500? What happens to various different risk assets? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. And full disclosure, this is not financial advice. So let's look at a couple of different data points. First of all, the S&P 500, despite the volatility this year, it's not really down more than 15%. That is not really a huge drop at all, especially when you consider the fact that the S&P 500, got to, funny money levels. It got to levels where, you had radical stimulus from the Federal Reserve doing, 100 billion plus quantitative easing each month. You had radical stimulus from the government, sending stimmy checks. This all pushed, lots of businesses that have no right to be in business, stationary bikes with an iPad attached, multi-billion-dollar valuations. You're looking at crazy levels in terms of the S&P 500. A lot of that has gone pushed out, but it's still only 15% down from when people were selling monkey pictures for millions of dollars, digital monkey pictures. You don't even get a real monkey, man. And so I that's one angle to think about. So the psychology, 15% is nothing. So then you think about the next aspect. Okay, let's do technicals. I don't spend a lot of time on technicals. Do a quick look. You see 200-day moving average, long-term trend. It's fighting the trend line. I personally look at the trend line is down. Maybe you get, a week or two where they try, the market tries to break it, but I don't think over 2-3 weeks, 4 weeks, I don't think a month from now it's above the trend line. I think ultimately that creates pressure. And I think everyone's aware of we're now in a downtrend for the S&P 500. We'll see where it goes. I think this is the real key thing to focus on, the fundamentals. So this blue little wiggly line, this is inflation over time. Got up way too high, and the Federal Reserve wants to get it back down to 2. You can see it's averaged out around 2% plus over a multi-decade perspective. So goal is to get it to the green line. That's what they want, this blue to get to the green. But what are your investment options right now? Well, you can hold cash. And I personally, cash is a very sizable position for my personal portfolio. I have my account at Interactive Brokers. You click the link below. They're currently paying over 3% as the Fed continues to raise rates. I expect that to go higher. So that's significantly better than most brokerages out there. You go to Wells Fargo, you get your savings account, it's paying 1% or less. You look at Interactive, I'm very pleased with the rates I'm getting there, 3% plus for cash at Interactive. So what are your alternatives? You have cash. You can own, let's say, treasuries. A 1-year U.S. treasury is around 4.7%. And then you have the S&P 500 trading around 20 times earnings. Now, 20 times earnings, you need to invert that. I wish people never learned earnings multiples and just looked at everything as a yield. So 1 divided by 20 is equivalent to a 5% yield. So the S&P 500, if they paid out all of their earnings, would be the equivalent of 5% yield for shareholders. So effectively, the Treasury, U.S. Treasuries, and S&P 500 is both around 5%. You're getting no premium for no yield, no risk premium for the S&P 500. That doesn't make any sense, especially when you consider all the macroeconomic pressures that you're potentially facing. You might be facing input costs. You might be facing an economic downturn, in which case earnings decline. It doesn't make any sense for the S&P 500 to be at around 20 times and for 1-year U.S. Treasuries to be around 4.7%. And so you're looking at that. So either U.S. Treasuries go down significantly or the S&P 500 goes down significantly because, once again, you're not being compensated for the risk that you're taking effectively. Effectively, 1 year out, why not own the U.S. Treasury? Because you're not getting that growth. Typically, you could make the argument, I'm comfortable paying, let's say, a same yield or slightly greater yield. I'll get a slightly better yield, with, some sort of market ETF like the S&P 500 because I'll get this growth component. But when you're facing such dramatic headwinds, like I'm calling out here, real macro headwinds, I'm not so sure that's so compelling, especially when you consider the psychology element, which is typically in recessions, you get lower valuations. So then you look at the most recent data point, payrolls and wages below past expectations, looking at strong wage growth. And this also gives pause to the market because you're looking at effectively more power for the Federal Reserve to keep raising rates, which will make it even tougher for the market to hold its value. This will make cash even more compelling. This makes the alternative, the opportunity cost of cash and interest rates relative to the stocks like, hey, what am I really getting compensated for? This is another example of how there's a real problem. There's a structural problem, with not enough effectively supply-demand mismatch. There's not enough supply in the labor market that can create structural inflation that could result to lower valuations and could result in greater pressure, let's say, on the S&P 500 in the near term. So Michael Burry, I think, is warning investors to consider selling. You've seen this rally. It's going up to a, near, let's say, a 200-day moving average. So it's going to a long-term trend line. We'll see what happens from there. I'm personally skeptical that it holds. And I think Michael Burry's rightfully sort of warning investors, saying, hey, people are overly focusing on, hey, what Jerome Powell's saying this day. The bigger picture is that the Federal Reserve is going to be in a real tough spot, because how are they going to deal with elevated inflation over time and potentially, a tougher economy? I hope this video has been helpful for you. If so, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for watching.